We have a few bits and bobs. So going through big macro as normal. What is liquidity? Then we're going to talk about updating your data set from which you form your opinion on, and I'll talk about that later. Then lunch, then guest speaker, then some business observations of Elon, because. And then we're going to do a stereotype niche trading game, so that'll be fun. And then another guest speaker, which is live Q&A with Biz, Taxman Collins. It's going to be much better than it sounds. No. I mean the whole day. Quickly moving on. Okay, so since the last cuddle, hey, hello, grab a seat. So not much has happened since the last cuddle. We've got ETF inflows, they've been continuing to increase. As you see in every trading pub, I look at the amount of Bitcoin that they're gobbling up, not the value of the Bitcoin. So that's going up, which is good. And I think that should continue, moving forwards for the next 100 years or so. The ETH ETF was finally launched, and that was interesting because a lot of big players said that would never happen because the SEC was solid that it was a security and it wasn't allowed, yada, yada, yada. But hey, BlackRock pushed that through. So we've got the ETH ETF. So we've just got to expect another couple of months of, silly buggers whilst they, pump it, dump it, all that sort of stuff.
The time period where they can, ban it or classify it?
Yeah, that's gone now. So expect a whole bunch of ETFs, Tau ETF, Casper ETF, like anything freaking. It's, full season now, which is good. Loads of big companies are adopting Bitcoin Jesus's Bitcoin reserve strategy. So if you're a big company and you're sat there on cash, lots of companies are now literally following it. More so in the East than the West at the moment, but give it a go, give it a while. Trump got shot. That was quite funny. And then the whole it's like a Netflix box set. What's going on? He gets shot, and then all of the drama in between, the Kamala shuffle around. But yeah, the CAS play. I'll talk about that later at the end of the day because we need charts to go through that because there's some very interesting price action there, which is not usual for a Trap 5 breakout. It's quite funny at that massive Bitcoin conference. RFK Jr. saying, "Hey, we're going to buy shitloads of Bitcoin. It's literally the only thing that will pay all the US debt off." Trump was saying, "Yeah, we'll do some Bitcoin stuff, yada, yada, yada." And then the US government dumped $650 million worth of Bitcoin, which is like, they're like, oh my God. So yeah, it's like they're trying to do everything to scupper anyone, or the Republicans, I guess. Hey, Virginia. I think there's a spare chair in the middle next to Lucinda, or anywhere really. And then other than that, not much really. Yeah, and this was the US balance dumping 650 million. So they've still got a fair few left though. Right, big charts, like we do in every cuddle. And these are I'm always saying you have to continually analyze the data set from which you form your opinions on. And not just, TV headlines and stuff like that. And you always have to come back to the big picture. And it's these big charts which very rarely move from cuddle to cuddle. But it's like your North Star. It should be your North Star. And it's really the big three which form the basis of everything. So this is the Fed funds rate. This is basically US interest rates. As you've seen, I've explained this chart so many times, but every time you have a does the pointer even work? Come on. Yes, it does. Does this work? Oh, it does work now. Anyway, every time we see a massive hiking of rates and then a mass cutting of rates, then you have the crash. Every single time, pretty much. And where are we now? We've been plateauing. So again, like I've said, every time you see a plateau of interest rates, you see a melt up in stocks. What have stocks been doing recently? They've been melting up. other than the last couple of days where everything's shat their pants. So, but again, we're just waiting. The UK cut interest rates for the first time in 4 years or so. Everyone else will follow suit. So you then overlay that with unemployment rate. Again, every single time you see a local low in unemployment, then a spiking of unemployment, then you have the crash. Then you add on inflation. Every time you see a mass hiking of inflation, then a drop in it, then you see a crash. So all these three things all shout to a big crash relatively soon. Now, the media will have you think that it's happening like now, or it's happening next week. I don't think so. I think that's just, bearish echo chamber. I think we've still got a little bit of time. And don't worry, you know me, I'm always early to stuff. So, and I don't think it's yet. We've got a bit of time. Remember, interest rates haven't started crashing yet. So we still, that gives us a good 3 to 6 months heads up. Because you tend to have at least 2 quarters of big rate cuts before any form of proper crashing happens. And then again, another one I found, which is the U1 unemployment figures. This goes back to the 50s again, but again, every single time you have a local low in unemployment, you then have a spiking and then crash. Again, the US 10-year yield is still growing, but that will revert. But the most important thing, this is the thing which I predicted ages ago. I don't know if you can see my blue ghost feed. This was like back in 2023. I was saying that we should see a massive spike up in the spread between the 10-year and the 2-year. And it's when we get to this sort of, this hole here, that's when the wheels start flying off the economy, and that's when we see the crash. We've had a big, nice V reversal here, and it is trucking up. But again, we've still got time. As much as the media want to say that it's, it's the biggest crash ever, just give it a, you have to understand that what's happening at the moment is it's a risk pullback, not a liquidity reversal. And remember, the liquidity rules everything these days, which we'll see later. So this is just people just getting a little bit scared. It's a risk pullback, not a change of liquidity. Again, US debt to US M2, nothing has really changed there other than the fact that this chart is now out of date, even though it's like a week old, because the US just hit $35 trillion of debt. 35 trillion. I mean, so we should be a little bit higher up here if I updated the chart. And look, it's just maths now. No matter what they do, maths takes over. Debt will always be higher than M2. Debt will always be higher than GDP. It's simple maths now. And again, I cannot find an updated chart to this. This chart was from the last cuddle. It seems like the Federal Reserve are not repainting this chart. Because 2 months ago, it was around 1.1 trillion in interest-only debt repayments. And a lot has happened since then. But no matter what website I go to, the last paint is like it was a long time ago. So I wouldn't be surprised if interest-only repayments was like 1.5 trillion by now. And again, I still see a lot of people going, yeah, but you don't understand. GDP is booming. It really isn't. The only reason GDP is booming is because M2 is going up. So this is US GDP. It looks great if you look at it on its own, but look at US debt. US debt will always be higher than GDP, and all of those two will always be higher than M2. And you just have to look at the budget deficit. I mean, it's just, I think that's the best chart, really, because you can see how much they earn compared to what they don't earn. This is how much. So if you just take this as 1.6 trillion, that's almost the equivalent of like you having a 40 grand a year job, but you're spending like 160 grand a month. So yeah, you're taking home like, I don't know, 2,500 a month, but spending like 100 odd grand a month plus. It's just, it doesn't make sense. Yeah, and that can only increase. Literally, the only thing the US can do to save this is to go YOLO into Bitcoin. Honestly, I've tried to analyze what things could they do. Could they do a debt? Okay, so they could do a debt jubilee. They could just go, I know we owe the world 35 trillion, but we're just going to stop. We're just going to, and then what's the world going to do? They got all the weapons and guns and ships and warplanes. Like, no one could really kick up a fuss, could they? If the US just went, yeah, we're just going to cut 9 zeros off that 35 trillion, and let's start again. Like the UK couldn't do that. No other country in the world could do that because you have Team America going, no, you owe us money. But the thing is, who does the US owe that 35 trillion to? It's to the US. It's to the Federal Reserve, the Bank of International Settlements, IMF, and World Bank. So, and those same people pretty much run America anyway. So it's a whole power control construct. It's not like how, yeah. And as a percentage of GDP, it's pretty bad still. So so this is the budget deficit as a percentage of GDP, which again is still pretty bad, but this is US debt as a percentage of GDP. It's over 120% right now. So yeah, it's not very good. We know the game plan. I've explained this in a bunch of trading pubs before. We know that they're trying to dump US Treasury bonds. They're trying to dump mortgage-backed securities to buy more Treasury bonds. Remember, there's a dramatic reduction in the amount of people that are buying US debt at the moment. Everyone's going, no, we've got enough of US debt. And so they're trying to find anyone and anything in order to sort of, so they're buying their own lemonade from their own lemonade stand at the moment by dumping some dodgy mortgage-backed securities. So, US real estate, this is an old chart. It has not updated. This will come plummeting down very soon. But first, it will be US real estate, commercial real estate that plummets first. But this is getting very frothy. And when you look at, say, the home builders inventory, we're getting to pretty high levels since 2009. This will continue going up, by the way. Don't think it's going to crash here. This got a lot more upside before it crashes. And so this is completed, but unsold homes from builders. And then when you have a look at under construction homes from builders, it's looking very frothy. So yeah, I think this is the only way that this is the only, as I said a long time ago, this is the highest probable outcome in my opinion. Now, US commercial real estate loan delinquencies, very slightly, again, it's like the Federal Reserve website is purposely holding back 6 months worth of data. All the charts I keep trying to update, they're all 6 months out of date, and I can't find any updated ones. I wouldn't be surprised if this was a lot higher, because I see loads of commercial real estate in San Francisco just going, like San Francisco's business sector is like empty at the moment. Other than Twitter, it's just empty. I mean, Steve went to San Fran not long ago, and you said you saw like zombies on the street.
So they've got a fentanyl problem there badly at the moment, and it's just like goes back. So it's horrible.
Or like just like sitting on the street, like fentanyl, like ODing, and yeah. And that's, as a tourist, you can see that. It's just, it's nuts. The US piggy bank is prime for a withdrawal. So this is the Treasury General account. So this is effectively the cash account for the US government. So this is one of the ways that they do a bit of QT. So when they want to sort of stop liquidity or try and dry up liquidity a bit, they basically dump it all into this TGA. But one of the first things that they do before they do any form of QE, quantitative support, or any form of printing, they'll bleed this dry first. So I study the TGA a lot. Again, this is an up-to-date chart. But when this starts crashing back down, that's like the warning shot of, okay, QE is starting here. So you see interest rates starting to cut. The US TGA will get absolutely bled dry. And then once they've got nothing else left, then they'll start printing. So how much is in here? They've got $851 billion there at the moment. So what they're going to, I don't know, it's more weapons for Ukraine, no doubt. And it'll go straight to the military-industrial complex. And then, again, I'm a big fan of Michael Howell's work from Cross-Border Capital. I think he's probably the only person on the planet that has the best liquidity construct, or the best model of liquidity at the moment. And again, this chart is still slightly out of date, but again, he hasn't updated it. I'm chatting with him. I keep prodding with him. I keep trying to get him to talk at a cuddle, but just calendar conflict. So we will get Michael. Come on, Michael. So yeah, don't forget there's a lag. So when we start seeing this trucking up here, there is a lag. So it takes time for all that money, that new liquidity, to percolate into asset classes. Normally 18 months, typically. So there's absolutely no change here. We are literally just got to get out of this halving bollocks area, and then we're in the green, honestly, there will be cuddles next year where you'll all be frustrated and pulling your hair out because you're making too much money and it feels wrong. Honestly, we've had many cuddles like that. Like in 2021, we're having cuddles where everyone was like, holy shit, this feels wrong. I've made like 50 grand in the last week, or or more. So next year, we're going to have champagne problem issues going, is it time to sell? Is it time to sell? Yeah. So that's the big macro.